Brian, I know you just got that report, and investors have been looking for clues here on how the Fed is thinking about its bond buying program. Did they get any clues in these minutes?
Yeah, absolutely. And it seems like there's a bit of a divide among the Federal Open Market Committee about what to do with those asset purchases and specifically how to communicate any sort of ramping up of its quantitative easing program. Again, that process of buying agency mortgage-backed securities in addition to U.S. Treasuries. Now, the minutes, again, from that November 5th meeting say that many participants judged that they would want to enhance their communication of the asset purchases, quote, fairly soon. Most of the participants on the committee favored moving to what they call qualitative outcome-based guidance for asset purchases, which would be saying in words the commitment and the pace by which they would be doing these purchases. And they want to link that over the horizon over which the committee would expect to be doing these purchases to economic conditions. So not necessarily saying we'll be committing to doing these purchases over a certain period of time, but based on what the closeness they are to their dual mandate, maximum employment, in addition to price stability. But on the other side of the committee, the minutes note that a few participants, so not all of them, but a few participants, quote, were hesitant to make changes in the near term to the guidance for asset purchases. They pointed to the uncertainty around the economic outlook, basically saying we don't really know what the future is going to look like with this very volatile virus. So maybe we shouldn't try to pin ourselves or tie ourselves to the post here if we end up not being able to deliver on that. So that's a chasm that's going to have to be resolved as we head into the Fed's final policy meeting of December 15th and 16th, where the expectation is the Fed could be unveiling some sort of new evolution on pinning its forward guidance to its asset purchase programs. Now, broadly speaking, the minutes also note that participants said there was elevated uncertainty surrounding the economic outlook. They were pointing to things like reports from their banking area contacts that showed households appeared to be burning through any sort of funds they received from the fiscal relief programs, whether or not that's enhanced unemployment insurance or other types of programs. And the majority of participants, as the minutes note, also apparently saw the risk that current and expected fiscal support, again, the lack of a second CARES Act, for example, might not be sufficient to sustain the activity levels that they saw as the rebound in the period between its September and its November meetings, which shows that, yes, the recovery is slowing, but in the absence of a fiscal package, that could turn in the wrong direction sometime soon. But again, the big headlines coming from the minutes that there appears to be some disagreement within the Fed about what to do with quantitative easing, in addition to the status quo of continuing to see the economic outlook as facing elevated risks. Alexis?
Well, Brian, there was some speculation this week that the expected appointment of former Fed Chair Janet Yellen to the Treasury would, in essence, give the Fed an ally and mean that they might not have to move so quickly on policy right now. Of course, the Fed didn't have this information at their last meeting, and so that's not reflected in these minutes. But do you think there's some truth to that if Yellen does, in fact, become Treasury Secretary, the Fed could sort of take a back seat, maybe take a breather, and hopefully she will push for the stimulus that we know Jay Powell has been asking for?
Alexis, as you rightly point out, the minutes are for the November 5th meeting, so there was no consideration necessarily of what the next Treasury Secretary would be doing. That's not normally a part of their calculations, even during this period anyway. But it is definitely a fair question to say, is the appointment of Janet Yellen going to change Fed policy if she is confirmed in the beginning of next year? And I think that the overall agreement is that because of her background at the Federal Reserve, she was a working colleague alongside Jay Powell, who during her time as Fed chair was a Fed governor. And I think the question is going to be, what does the economy look like in January? We already barely know what the economy is going to look like next month. So I think that when we talk about whether or not there will be another fiscal package, where the virus will turn, whether or not there will be more shutdowns across the country, those will be indications of what Fed policy, in addition to the Treasury, will have to do next year. Considerations like, should they be reopening 9 of those 13 liquidity facilities that are scheduled to close as of December 31st, as we saw in that beef between the Treasury and the Fed last week. The Janet Yellen-led Treasury, if she is appointed, could reopen those facilities. There's a little bit of legal ambiguity around that, but could be more aggressive in trying to reopen those facilities. But again, I think that the Fed and the Treasury will be cautious to try to provide more stimulus unless it looked like the economy was really turning another corner towards the downside with the virus cases rising. So I think that this particular meeting, which we saw from November, showed that there was a concern that that could be the case, again, as that fiscal support was expiring, households burning through the stimulus checks, in addition to the unemployment insurance help, it really doesn't really necessarily spell a very bullish outlook for where the economy is going to go. Very different story than what we've been seeing in the stock market over the past few weeks.